Hi guys, welcome back to the channel. My name is Dave, and have you ever bought a great stock because you love it and then sold a call against it because you want a little extra income and you're a smarty pants, and then had the stock it takes off, right? It goes right past your strike price and it keeps going higher and higher because it's a great stock. You picked the right one. Then you have this regret. Why did I sell that call in the first place? And I get the question a lot, how do I fix this situation? As if there's some kind of bring in the button. There's some magical boop, undo, create money for me magic button. But it doesn't exist. I'm sorry to tell you. But it doesn't mean we can't, think through this and maybe manage the situation. After all, we have won because we did make some money in the first place in this situation. So let's talk about it. If that is what you're looking for, please stick around. Boop. And for some reason, this situation reminds me of Amy Poehler and Josh Brolin in an old SNL skit where Josh is checking out Amy from across the room. That's the stock that he likes. And he decides to make his move by selling a covered call, only to see the stock take off and then Amy stand up. He has some regret. He decides, I don't know, this isn't right for me. All my friends, they're making fun of me. What do I do now? But then after some careful analysis, he decides it's not so bad. I made some money and I can work with this. So now let's start thinking about our actual situation, right? We bought a stock, sold a call, stock takes off. We're looking at our option. It looks terrible in our account. What do we do? Where do we go from here? And the obvious answer is we're going to roll this option, but what do we roll to? So we'll look at some different ways to approach this problem. But I think it's important to understand my perspective when it comes to options. I'm more of a math guy. I look at things as a probability as much as I look at it as maybe a source of income. So I toss out technical analysis for the most part. So if you watch videos and people start talking about their indicator, their MACD, right, moving average, convergence, divergence, your support resistance bands, your Bollinger bands, all these different things, not a big believer. I'm sorry. You're going to have to really convince me. From a math perspective, it's hard for me to buy into these ideas that in 30 to 60 days, you can predict where that stock's going to be. It's kind of a guessing game. So for me, it works out better if I approach it from a probability standpoint. So what does that mean, Mr. Math Guy? Well, I like to think of myself as a buy and hold investor. So I like to determine what I think is a great stock or ETF. I like to buy it and watch it go up in value over time. I know, novel idea. But I do like to use options to hedge my portfolio, reduce the volatility, maybe add some income during those big drawdown moments. You know the situation. And I typically don't sell calls against my whole portfolio either. I like to have some just pure equity exposure for that upside. And I like to roll to strikes that make sense for my overall objectives. So I'm not really looking at indicators so much as I'm looking at the probability of capturing a little bit more upside or maybe a little bit more income and determining it based upon that. So with that in mind, let's look at an example. So for this example, I'm going to use the current trade that I'm in where I have a decision to make by this coming Friday on what to do with my now deep in the money call option. So this is with SMH, that's the VanEck Semiconductor ETF. And just to give you a little bit of a background, back on 9/22, I decided to buy 110 shares of SMH at a price of $318.70. I immediately went out and I turned around and I sold a call option out to 10/31 of 2025 at a $335 strike price, 5% out of the money. So I have 5% upside, looking pretty good. And I collected a premium of $584.33, looking pretty good combined. That's a nice, healthy return if this thing, happens to take off, which is exactly what it did, right? It took off. It's all the way up to $351.14 now. So, decision time. What do I do? Do I let it get called away, take my gain and walk? Or do I roll it out to some new strike price and try to grab more income? What would you do? So let's talk about our options a little bit with this particular option. And the first option is you bought this stock, it went up in value. Maybe you just let it get called away. In this case, it's like Amy when she stands up, right? She stands up and you're taken back. Damn, I wish I wouldn't have sold that call. But now you realize that, you made some money. It's not so bad. Maybe I'll go for it, right? And that's kind of like the first thing. You can just let it go. So maybe you're overexposed to SMH and you decide you just don't want that exposure anymore. I'm going to let it get called away. How did I do in my trade? Well, if I run my numbers, I bought it at $318.70. I sell it at 335. That gives me $1,630 of price appreciation. I get that money. Consider your tax situation. And then I also got $584.33 of option premium. So if I do nothing, if I don't even try to roll this and it gets called away, this coming Friday, I make $2,214.33. That's not bad, right? 9-month pregnant Amy ain't so bad. It sounds pretty good. So if that's your situation and you want to move on to another trade, go for it. You don't have to do anything. Just let it get called away. Our other options are going to deal with rolling. And some people think rolling is this magical solution. I just think of it as buying to close your old position and selling to open a new position because that's what rolling actually is. So, you initially sell to open a contract, then you want to buy and close it, and then you sell to open, and that's the roll. So if you click roll on most platforms, it's going to bring you to something like this. This happens to be Fidelity. So in this case, I'm buying to close my old contract of SMH with that October 31 expiration, which is again this coming Friday. I'm going to sell to open a new contract with a call expiration. With every one of these, I'm going to pick a month, but certainly you could add more time to that and collect a larger option premium, maybe roll up to a higher strike. There's lots of flexibility there and you can kind of play with those, but I want to be consistent and pick 3 different strike prices, focus on that, and just kind of take the expiration date out of the process. So I'm going to pick Thanksgiving, right? November 28th. And we're going to start out by rolling it straight out and then we'll work our way up. So again, buy to close, sell to open, that's your option roll. This will give you your new short contract that you would be involved in. Now, one negative to doing this on the weekend, I think I might have said this earlier, but we're going to have these really broad bid and ask spreads, and it's terrible to look at, but we'll work through it. We'll kind of take the midpoint with both of these, understanding that we won't quite get that midpoint, but you get the idea. So we have a $335 call option right now. If we wanted to just roll out 1 month, keep the same strike price, can we add some funds to our trade with something that's going to be pretty deep in the money and offer us some protection? And I say, yes, we certainly could. So if we go out to that 335 strike price, don't try to increase the strike at all, we're going to be able to get, again, looking at the midpoints here, around $7.20 for this one contract. So by rolling it out, we get a net credit of around $7.20, right, give or take. So I bet you'd be able to get around $675 to $700 for this based upon how wide these bid and ask prices are. It's one of the negatives to these types of ETFs. You might not have the volume that you would have. Like if you did this with NVIDIA, that bid and ask spread are going to be really tight. If you did this with IBIT, like an IBIT option chain, it's going to be really tight. So this is pretty broad. But think about this. 1 more month of risk or exposure to this, where you're hoping this continues to climb higher or stay above your strike price, results in $718 of additional credit, right? So nothing else changes. We're adding $718 to our already successful trade just by rolling it straight out. And that looks pretty attractive as option number 1. And for somebody that touts probabilities, just understand this a little bit better. I'll pull the option chain up now. This is about a 70 delta call option that you're selling. So 70% of the time, just a back of the napkin number, this should expire somewhere in the money where they're still going to call away your shares and you'll keep the full option premium for doing this trade. Again, it's a net credit of $718.70. So the way you would keep your shares, of course, is if it falls back below that 335 strike price, which we're saying 70% of the time that won't happen. 30% of the time it could. So about, 1 in 3 chance it falls below that. That's where you want to start thinking about your break-even points. So if it does fall to 330, did you make money on this option trade? Yes, you would have netted out around $200 because you lost $5 below that. That's what the stock value is now. This is a good little option for people that want to be conservative and have a pretty high probability trade and keep that same strike price. So another option is to roll up the strike price, but still try to get a net credit from the trade, but try to capture more upside. So maybe in this case, you want to try to manage the position, keep your shares, but still be relatively conservative and add income along the way. This is really popular, and this is, I think, what probably the majority of people tend to do. So in this case, we have a 30-35 strike, and we can play around with this. So can we roll it, again, keeping the expiration date the same, up to a 340 strike price? And again, I'm going to go with the midpoints, and we can see, okay, we're still going to be able to generate a net credit based upon this midpoint price. How about 10 points up? Let's go to a 345 strike price. In this case, just a little bit, all right? So it shows up as a net debit because it's looking across here. But from the midpoint on, we can see that the 345 strike gives you just a little bit. So this is kind of the break-even trade. So this is an interesting one to kind of look at and dissect a little bit. So in this case, we can add a month. We can go to a 345 strike, and this is probably around a 60 delta. I'll try to put that up there to illustrate that. Again, a little bit over 50%. We're saying 60% chance that this does get called away and stays above our strike price because the price is clearly above the strike price that we are selling. So by doing this, we're going to add a very small credit, pretty much a break-even trade, but we get to roll it up 10 points, sell this for $1,000 more if it stays above the strike price. So another good option, and what I see most people do, most people I think would pick the 340 to the 345 strike price and try to add a little bit of a net credit income as they roll up the strike a little bit and try to capture more upside, especially if they have just a positive view of SMH and want to trying to continue this trend with SMH as it's plowing higher and higher. And a third option is to roll out your option above the current price of the stock or ETF that we're looking at. So above 351.14. In this case, you're looking for that upside potential. And if you are a fan of covered call ETFs, like the NEOS products, for example, if they had one based upon SMH, they would buy to close this option. They would sell an out-of-the-money call above the current price to capture some price appreciation and hopefully some option income. That's how these function. Most of them function that way. So in this case, we would sell to open 1 November 28th, but we're going to go above 350. We're going to go all the way up to 360. All right. So in this case, we're looking for about $9 or $900 of price appreciation. And for that, in this case, because the price moved so quickly, we're going to have a debit. So in this case, we went to that midpoint. In this case, it would cost us about $780 to close our old option and then open up the new option at a $360 strike price. But let's not forget what we're actually accomplishing here. We're rolling from a $335 call to a $360, right? That's significant. That's $2,500. So if this continues to climb higher and higher, if you're a big believer in SMH going forward, this would be the best option, right? Because it gives you $2,500 of upside potential. It only costs you $800 to get that potential. And you can certainly roll to a higher strike price like 370 or 380 if you're willing to take that loss on the option trade, but give yourself more opportunity for price appreciation within SMH. So if you're really bullish, look for those higher strike prices in a lower delta value, right? Because you want to maintain those shares. So in the case of the 360 strike, that's a 44 delta call option. So you have a better chance, better than 50-50 chance that you're going to keep those shares by selling this call option and taking the loss here, but giving yourself room to the upside. But the point here is, if your perspective is, or maybe your position within SMH is you have a ton and you have a lot of exposure to NVIDIA with NVIDIA earnings coming up, I think it's more important than that, using that to pick your strike price, than to look at a chart and look at the MACD and your support and resistance levels to choose what strike price you're going to sell. So what is the answer for me in this situation? Well, when you sell a covered call, the goal is to sell the exact price where it's going to be come expiration day. As I mentioned, I don't think you can really do that. When you do it, you give yourself a pat on the back and you know you got lucky. But that is the ultimate goal. In this case, considering my exposure to NVIDIA, which I'm very bullish on, SMH, which I'm very bullish on. I have a lot of VGT. That's probably my largest ETF that I own. So in that case, I'm okay giving up these shares. So this is more of an income grab in my situation. So I'm probably going to roll this straight out or out and up just a little bit. I would like to maintain my shares, but I kind of like the idea of still being in the money with a little bit of security. If that doesn't make sense, watch this video next, which was from last week. kind of talking about how to maintain this and why you might consider selling in the money calls. But yeah, that's kind of my perspective. I don't think there's a wrong answer in this case. Whichever one is best for you is the right answer. So I will post a poll on my channel where you can tell me, is it option 1, 2, 3, or 4, and I'll spell those out. And you can let me know what you would do based upon the information that I presented. I'd love to hear from you. Now, if you have any questions on any of this, please ask down below. Like and subscribe if you like this type of content. And check out one of these videos next if you have more time you want to waste with me right here on Wealth Adventures. Again, we'll talk to you soon. Thanks for watching. Have a great night. Take care. Whoop.
What did your baby do?
Yesterday.